transactions and journalizing, let us take another few examples. Bad debts written off. See, whenever we have sold goods on customers on credit basis, debtors will be considered as an asset. However, in certain situations, debtors they become insolvent or they become bankrupt or they are unable to pay. So it is irrecoverable to the business. When it is irrecoverable, it is a loss. So we have to write it off from the books of accounts. We have to remove it from the books of accounts. So in this case, the two accounts involved here is bad debts and the debtors. As per traditional approach, bad debt is a nominal account, debtors is a personal account. As per modern approach, bad debts is an expense, whereas debtor is an asset. So in this case, bad debts loss or expense is increasing, debtor balance is decreasing. So the journal entry will be bad debts account debited to debtors account. Another transaction example is discount received from creditors. See, whenever we make payment or whenever we have achieved a quantity purchase, bulk quantity purchase, discount is allowed by the creditors to us. So the two accounts involved here is creditors and discount. So creditor is a personal account, discount is a nominal account. Whereas modern approach, creditor is a liability, discount received is an income. So in this case, when the discount is received by the business from the creditors, our liability will decrease to the creditors and discount received is an income which will increase. So the journal entry will be creditors account debited to discount received. Bank loan taken. The another example is bank loan received. This is a common business transaction where the businesses take bank loan. So the two accounts involved here is bank account and bank loan account. So bank account is a real account, whereas bank loan is a personal account. Whereas as per modern approach, bank is an asset, bank loan is a liability. So when the bank loan is taken, we get money in the form of through bank account. So bank account will increase, bank loan also will increase. So the journal entry will be bank account debited to bank loan. Loan given by partner, another example. So the loan given by partner. At times the partnership firms, if it is finding it difficult to manage finance, the partners give loan to the firm. So the two accounts involved here is cash account and partners loan account. So cash is a real account, partners loan is a personal account. As per modern approach, cash is an asset, partners loan is a liability. To the business, cash balance is increasing, partners loan is also increasing. So the journal entry will be cash account debited to partners loan account. Another example for the transactions in the business is bad debts recovered, which was written off earlier. In our previous one of the example which we had written off the bad debts, now in this situation the bad debts have been recovered, which was written off earlier. So the two accounts involved here is cash account and bad debts recovered account. Cash account is a real account, whereas bad debts recovery is a nominal account. As per modern approach, cash is an asset, bad debts recovered account is an income. So in this case, cash comes into the business, increase in asset, cash account debited to bad debts recovery account. Students generally make mistakes here. They use debtors account here. That is wrong, because when the bad debts occurred, when the bad debts happened, we had written off earlier by striking it off from the debtor balance, right? So now when the bad debts is recovered, we should not use debtors account. Please remember this. So cash account debited to bad debts recovery account. Another examples like expenses paid. So many types of expenses, revenue expenditure paid by the business like telephone, wages, salaries, electricity, telecommunication, telephone, traveling, transportation. All these are expenses to the business. So expenses are nominal in nature, whereas cash is a real in nature, real account in nature as per traditional approach. Whereas as per modern approach, expenses, telephone expense, wages, salary, all are expenses, whereas cash is an asset as per modern approach. So whenever the expenses are incurred by the business, it will increase in the books, whereas cash, when it is going out, it will decrease in the books. So the journal entry will be telephone expenses account debited to cash account, or any expenses account debited to cash account. Sales return from customers, another example. Whenever the business has sold goods to customers, later on, subsequently, customers might reject the goods considering the defective or poor quality. So, in such case, business gets the goods back into the business. To that extent, our income gets reduced. So, here the two accounts involved here is sales return and debtors account or customers account. Sales return, as per a traditional approach, is a nominal account, whereas cash account is a or debtor account. Sorry, for example, if it is earlier sold on credit basis, we had used debtors. So similarly here also, when the sales returns happening from the debtors, so debtor balance will reduce. So debtor account we have to use. Two accounts are sales return and debtors account. Contrastingly, if it is a cash sales earlier and it is returned back, we have to give them cash back. So there are the alternatives possible here. So assuming earlier sales were done on credit basis, now the sales returns from the customers involve two accounts, sales return and debtors account. Sales return is a nominal account, debtor is a personal account. Whereas as per modern approach, sales return is an income, whereas debtor is an asset. Why I am treating sales return as income? Because it is a reduction in income. It is opposite to sales. So sales return, considering as an income, it is reducing, whereas debtor balance, it also being an asset, it is reducing. So the journal entry will be sales return account debited to debtors account. So similarly, purchase returns to the suppliers. When we purchased goods earlier from the suppliers on credit basis, now if we are returning it back, considering defective or quality issues, the two accounts involved here is creditors and purchase returns. So creditors is a personal account, purchase return is a nominal account. Whereas as per modern approach, creditor is a liability, purchase return is an expenses. So expense is reducing, creditor balance is also reducing. So journal entry is creditors account debited to purchase return account. Let us understand some complex transactions and their journal entries. Outstanding salaries. So the two accounts involved here is salary account and outstanding salary account. Students make mistakes here, generally what I have seen. So salary and outstanding salary. So be careful here. So salary account is involved and outstanding salaries account is also involved here. Salary is a nominal account, whereas outstanding salary is a personal account, being a representative personal account. As per modern approach, salary is an expense, whereas outstanding salary is a liability. So when the salary is outstanding, we have to pass this transaction considering the accrual concept, periodicity concept, as well as matching concept. So salary, we have to recognize it as an expenditure of this period, considering accrual, periodicity and matching concept. So in this case, salary expenses is increasing, whereas outstanding salary is also increasing because we have not paid it. It is the liability being increased, we have to credit. So the journal entry will be salary account debited to outstanding salary. Another complex example is prepaid rent. The two accounts involved here is prepaid rent and rent account. So when the rent is paid in advance, we have the right to use that particular premises for that period. So prepaid rent will become an asset as per modern approach, whereas prepaid rent is a personal account as per traditional approach. Whereas rent is an expenditure as per traditional approach and rent is an expense as per modern approach. So when the rent is paid on a prepaid basis, so two accounts generally involved is prepaid rent and rent. There is an alternate possibility here. When prepaid rent is given, alternate transaction analysis will be prepaid rent account debited to cash account. If in case this transaction, if you have not done, alternate transaction journal entries also you can write, that is rent account debited to cash account, and reversing the rent considering the prepaid rent account debited to rent account. So for this there is a alternative journal entry is possible. So two accounts involved here is, if it is alternative one, prepaid rent account debited to cash, and in another scenario if you adopt the alternate way, so rent account debited to cash and prepaid rent account debited to rent account. Here basically rent account we are setting it off because it is not the current year expenses. So that's why rent account debited in the second alternative, rent account we debited, and in the immediate transaction, immediate journal entry, we reversed the rent account by crediting it because it is not the current year expenses, considering the periodicity concept, accrual concept, and matching concept. I hope this is understood. Similarly, another example for business transaction is interest on investments accrued. Say as a business, when we might have invested in some assets such as, for example, fixed deposits or loans we might have given. So it is an investment to the business. So on those investments, if interest is accrued, accrued means we have the right to receive but we haven't received it. Accrued. We have not received but we have the right to receive. So the two accounts involved here is accrued interest and interest account. Accrued interest is a personal account, whereas interest is an income as per traditional approach, nominal account. Whereas as per modern approach, it is a accrued interest is an asset because we have the right to receive, legal right to receive. Whereas interest income is an income as per the modern approach. So when accrued interest asset increasing, interest income is also increasing. So the journal entry will be accrued interest account debited to interest account. Another different set of example is goods withdrawn for personal use. Whenever goods have been withdrawn for personal use, two accounts involved here is drawings account and purchases account. The reason why we use purchases account is because the goods which we had purchased for business purpose in the ordinary course of business, it is a direct expenses to the business which we have used purchases account. All our purchases of goods we have used our purchases account. So since the goods have been withdrawn for personal use and not sold, we have to reduce the purchase expenses by crediting it. Whereas drawings is a personal account of a owner, the liability decreases, so the drawings account has to be debited. So as per a traditional approach, drawings is a personal account, whereas purchase is a nominal account. As per modern approach, drawings is a it is opposite to capital or liability, and purchase is an expense. So drawings, that is capital. If you consider drawings, it is increasing. If you consider capital, it is decreasing. So capital or drawings, you can use it interchangeably. So if we consider drawings account, it has to be debited. If we consider capital, it has to be debited only. So whereas purchases, the expenses will decrease, business expense will decrease because you have used it for personal purpose. So purchase account will be credited considering the decrease in expenses. Another transaction example for goods related is goods given on sample. At times what happens, businesses, they give goods on sample basis to the customers to promote sales. So the two accounts involved here is sales promotion and purchases. Sales promotion is a nominal account as per traditional, and purchases also a nominal account as per traditional approach. Whereas modern approach, sales promotion is an expense, whereas purchase is also an expense as per modern approach. So sales promotion expense is increasing, purchases account is decreasing because purchases is a direct expense, sales promotion is an indirect expense. So one expense is increasing, another expense is decreasing. So sales promotion account debited to purchase account. So, students, there you have it, the perfect dance of debits and credits that keeps the business world spinning. Remember, every transaction has at least two partners, debit and credit. The total value of debit always equals the total credits. So, next time, if someone asks you about debits and credits, you can confidently say, "Oh, they are just dance partners in the accounting world, and I know all their moves." Students, visit our channel for more CA Foundation simplified concepts, and please share this video to your friends and relatives, and please subscribe our channel Lator Academy. Thank you.